Hello guys, hello, a very good afternoon. I hope it's properly audible. Yeah, very good afternoon. So, as I've been telling you since the dates for May 2022 exams already have been announced, we are in the process of conducting small revision lectures relating to amendments. Today, on the Unacademy's YouTube site, I plan to take up a small revision lecture based on these special rates of tax. Can subscribe to the plus course also. You can use this code. Combo offers an iconic subscription. All of this is available. So chalo, quick fire revision for uh, this concept. Simple tax rate discussion, nothing new to teach, but just the fact that these are all going to come up in your questions as small adjustments. So we'll just have a quick glance through it. Chapter 12 of Income Tax Act prescribes all the special incomes. What do I mean by special incomes? I'm talking about all those incomes for which a special income tax rate has been prescribed. So all these incomes that we are currently talking of, they are always going to be included in total income. Under the relevant head, they will always be part of total income. They will always be included, they will always be recorded in total income. Much better. Okay, so all these incomes are always going to be included, always going to be part of the total income. But the thing is that when you start calculating your income tax, these incomes will have to be separated out and a special tax rate has been prescribed. So they will not be subject to income tax as per normal rates. You'll have to pay tax at a slightly different rate. You'll have to pay tax separate rate of tax specially created for them. Now, first three incomes that we'll take up for revision: capital gains. If I am talking about short-term capital gain, so short-term capital gain, if it's covered by section number 111A, then we will pay tax at the rate of 15%. What is covered under 111A? Three assets are covered under 111A: equity shares, units of equity oriented mutual fund, and units of business trust. These assets, they should be sold through a recognized stock exchange in India. The moment you sell them through a recognized stock exchange in India, there will be securities transaction tax. When you pay securities transaction tax, short-term capital gain will be taxed at the rate of 15%. Of course, securities transaction tax is not going to be allowed as deduction while you compute your capital gain income. Short-term gain, so therefore there is no concept of indexation, obviously. On these three specific short-term capital gains, we will be paying tax at the rate of, on these three type of capital gains, short-term in nature, but on equity shares, units of equity-oriented mutual fund, and units of business trust, 15% is the rate of tax. Small relaxation that is given is to promote this concept of IFSC. That if your stock exchange is located in IFSC, you don't have to pay securities transaction tax, but still section 111A will definitely apply. Against this short-term capital gain, you cannot claim any deduction under chapter 6A. So the intention of the act is that this income should not be reduced in any way. It is included under the head capital gains, and the full amount is subject to tax. You cannot take any chapter 6A deduction towards this short-term capital gain. If by chance, if you are a resident individual and resident HUF, and other than short-term capital gain, the balance income that you have, total income minus this short-term capital gain under section 111A. If this balance income that we are talking about is less than the basic exemption limit, then whatever basic exemption limit you cannot adjust, you cannot absorb, that unabsorbed basic exemption limit will be reduced from the short-term capital gain under section 111A. Now what balance remain? This balance short-term capital gain will be taxed at the rate of 15%. So yes, you will definitely get the benefit of basic exemption limit one way or the other. If your other incomes are lesser than basic exemption, whatever exemption limit you could not adjust, no problem. Take the benefit of that basic exemption limit which you cannot adjust against short-term capital gain under 111A. Balance gain you will pay tax at 15%, always included in your gross total income. For short-term capital gain, this is the only section where a special tax rate applies. Long-term capital gain. Long-term capital gain is covered by two sections. One is section 112A, which is a more specific section. Second is section 112. Section 112 is general in nature, and section 112A is a bit specific in nature. So obviously, you will check the specific section first. You will study the specific section first. Any long-term capital gain which is covered by 112A, that section will apply. But any long-term capital gain for which 112A does not apply, then you will pay tax under section 112. Remember that for long-term capital gain, your budget income tax rates do not apply. Whatever is the rate of tax applicable as per the budget or announced by the budget is not applicable for long-term capital gain. Long-term capital gain will be taxed either under 112A or 112. Specific section first. The same capital assets which are covered in 111A, they are also covered in section 112A, but the only difference is that in 111A they are short term and in 112A they are long term in nature. You will get an exemption of 1 lakh rupees. Your long term capital gain, when you calculate tax, this exemption of 1 lakh is at the time of calculating tax. You will get an exemption of 1 lakh, and the balance long-term capital gain, you will pay tax at the rate of 10%. Long-term capital gain, so generally indexation is available, but because a concessional 10% tax rate is applied, there will be no indexation allowed. Computation will be done without giving effect to first proviso, which means even if the assessee that we are discussing is a non-resident, the computation will still be done in Indian currency, and the benefit of indexation will not be available. In this case, tax rate will be a concessional rate of 10%. One of the important conditions to satisfy. If you want this section to apply for equity shares, then STT should be paid at the time of acquisition and at the time of sale. Securities transaction tax should be paid at the time of acquisition as well as at the time of sale. Only then this section will apply. If you do not pay STT at the time of sale, that means you are selling the equity shares outside the stock exchange, 112A will not apply. You will have to look at section 112 to find out the tax rate. If you have acquired equity shares but not paid STT at that point of time, the general rule is that 112A will not apply. You will have to pay tax as per section 112. So STT has to be paid at the time of acquisition, has to be paid at the time of sale in case of equity share. But if we are talking about units, so when I say units, units covers units of equity oriented mutual fund also, and units of a business trust as well. Then the only condition is that STT needs to be paid at the time of sale. Bas, that's it. Then this section will apply. Same relaxation that if you are located in a EFSC, there is no need to pay STT at the time of sale, but yet section 128 will continue to apply. Government came out with a notification in 2018. It said, okay, there are certain situations, there are certain transactions where genuinely it is not possible to pay STT at the time of acquisition. Example, when bonus shares are acquired, when ESOP securities are acquired, when the company allots right shares, situations like amalgamation and demerger, where the person who is today selling the equity shares through the stock exchange has acquired the equity shares outside stock exchange, therefore has not paid STT, but then has not paid STT because the transaction is not possible only to execute in the stock exchange. Then these type of transactions are notified by the government and said that, okay, yes, what is the general rule? The general rule is that STT should be paid at the time of acquisition. Fair enough. But now we are giving you an exception to that general rule. If your situation falls in this notification, then it's absolutely fine that you have not paid securities transaction tax at the time of acquisition, but still we will allow you to use section 112A, and you can pay tax at the rate of 10% after claiming an exemption of 1 lakh. Same concept as was applicable in short-term capital gain, that no deduction under chapter 6A will be allowed. Again, if you have any basic exemption limit remaining unabsorbed, you are allowed to adjust the unabsorbed exemption limit from the long-term capital gain. Please remember that this is not the same as 1 lakh rupees. So which means definitely I will be getting an exemption of 1 lakh, but I can adjust my basic exemption limit remaining pending against the long-term gain. Then the balance long-term gain, I can take an exemption of 1 lakh. Now, if there is any long-term gain still remaining, this will be taxed at the rate of 10%. Many students also have this small misconception, and so just putting up a small note here. the entire amount of long-term capital gain, the entire amount of long-term capital gain will be included in GTI. Say for example, your long-term capital gain under section 112A, as we have computed without giving indexation, without allowing STT as a deduction, say this works out to 3,25,000. The exemption of 1 lakh rupees is not given by section 10. 1 lakh is not exempted as per section 10. Nah, 1 lakh is exempted under section 112A. That is why you may understand what I meant when I wrote that this is an exemption only for the purpose of calculating income tax. So this exemption is to be allowed at the end when tax is calculated. But this entire 3,25,000 will be included in the gross total income. Then eventually when you start calculating income tax, take this 3,25,000, subtract 1 lakh, pay 10% tax on the balance 225. But that does not mean you will only include 2,25,000 in GTI. No, GTI will include the full 320. An extra point, this point is not available, this point is not existing for short-term capital gain under section 111A and long-term capital gain under section 112. If you are paying tax under these two sections that I am currently discussing, 111A and 112, definitely rebate under section 87A is allowed. But if you are paying tax under section number 112A, then there is no rebate available. No rebate will be allowed. This is the only long-term capital gain. Tax on this long-term capital gain is not eligible for any rebate, which means, you know, when we calculate rebate, we do a working something like this. When we calculate rebate, we do a working something like this. The amount of tax, basic tax, or maximum 12,500. Now, whichever is lower of the two. Now, what I will have to do is I'll have to say basic tax minus the tax that I pay under 112A. Not entitled to rebate, which means that tax I will definitely have to pay. There will be no rebate available for this tax. Specific section 112A. Now coming to a slightly more general section 112. Again, here long-term capital gain is covered. But any long-term gain which is not covered by 112A will be covered by this section. So all other capital assets, property, plot of land, jewelry, debentures, equity shares, but private limited company ka equity shares which do not get covered by 112A. STT was not paid at the time of sale. STT was not paid at the time of acquisition, but you are not covered by that notification. Mutual fund units other than equity oriented units. Every long-term capital gain which is not covered by 112A shall be covered by 112. In section 112, my rate of tax is 20%. And generally speaking, because it is long-term capital gain, indexation is going to be allowed. Now, there is this option available. Option. And it's pretty obvious what option will be selected. The option is available for listed securities other than a unit. So units of mutual fund, etc. are not covered. They should be listed and zero coupon bond. What is the option available? Generally speaking, I will pay tax at 20%. Generally speaking, indexation will be available. But the option says, ek kaam karo, do not claim indexation. Compute your capital gains deliberately without indexation. But on that capital gain, which will obviously be counted on the higher side because there is no indexation allowed, you will pay tax at the rate of 10%. Now, this is an option given to you. Either you pay tax at 20% after allowing indexation, or you pay tax at 10% without allowing indexation. You are given an option. You can pay any one of the two taxes. So, but obviously, if an option is given to me which tax to pay, I will choose whichever is lower. This is available for listed securities and for zero coupon. So if it is unlisted securities, property, jewelry, there is no such option of 10% without indexation. The rate of 20% with indexation will. Specifically to encourage non-residents, a separate clause is introduced. If you are a non-resident, then even if it is unlisted, no indexation allowed, mandatory, pay tax at 10%. In case of unlisted securities or shares of a closely held company. See, the point that we studied here, just a second. The point that we studied for listed securities, this is available to all the assessees, but it is an option. So you can still choose to pay tax at 20% after allowing indexation. But as far as non-residents are concerned, this is not an option. They will pay tax at the rate of 10% without giving effect to indexation. Now, why this? The reason is very simple. If you are talking about securities and the assessee in discussion is a non-resident, obviously the non-resident would have purchased the capital asset using foreign currency. Now, the moment you use foreign currency, first proviso comes into picture. If the securities are listed, you will compute your capital gains in foreign currency. Since first proviso applies, indexation, second proviso does not apply. Indexation not allowed. And for listed securities, non-residents as well as residents, everybody has that option to pay tax at the rate of 10%, 20% with indexation, but indexation is not available. So it will be 20% or 10%. So obviously the tax rate that we will choose is 10%. But if it is unlisted, the problem that used to exist, it was a problem that used to exist about maybe 8-9 years ago or a decade ago. Since you are a non-resident, your computation of capital gain would still happen in foreign currency. Indexation would not be available, but the option of 10% was available only for listed. So as far as unlisted are concerned, they had to pay tax at the rate of 20%. So this was the problem, and people were not, the non-residents were not willing to invest into unlisted securities. So government brought about this change. They said, okay, this will be taxed at 10% only, mandatory. Computation will be done in Indian currency. Now, whether you compute your capital gains on listed securities, there also indexation is not allowed. Unlisted securities, indexation is not allowed. Tax rate at both places is going to be 10%. So to keep a level playing field, to keep a equality between the two situations, whether it is listed security or unlisted security, I will end up paying tax at 10%. But for unlisted, it's not an option that is given, it is mandatory 10%. Concepts like Chapter 6A deduction not allowed is available in all three. The concept of unabsorbed basic exemption limit, that is also available for this capital gain. So all the three capital gains all three capital gains where special rate of tax is prescribed, if your basic exemption limit remains balanced, if your basic exemption limit remains unabsorbed, you will be allowed to adjust your unabsorbed basic exemption limit. You can adjust it against all three types of capital gains. So these three sections were specifically applicable to capital gain. Chalo, going ahead now, pretty small and pretty simple things. Maybe from your CA inter studies, you might remember this also. Some of them, I mean, if you have winnings income, puzzles, games, gambling, betting, lottery, all these type of incomes will be taxed at the highest rate, 30%. No deduction allowed. Chapter 6A, you cannot set off any losses. Even basic exemption limit is not applicable. So what it means is the concept that you just studied about unabsorbed basic exemption limit, this concept is not applicable to your winnings income. Winnings income is casual in nature. It depends on luck. And so we are going to tax you at the rate of 30%. But if your exemption limit is pending, you will not be allowed to adjust the exemption limit. You will have to pay the full tax at 30%. This is 115BB. Head of income is always going to be income from other sources. As far as winnings income are concerned, I may mention one thing also. No expenditure at all is allowed as a deduction. So the gross amount will be taxable. No reduction at all. No chapter 6A deduction. No expenses allowed. No set off of any loss, etc. Everything will be subject to tax at the rate of 30%. Next section, 115BBA. This is something that is discussed only at CA final level. Certain assessees are covered here. Basically, the common thing is that we are talking about non-residents. Who are the assessees who are covered here? Number one, I have a sportsman, but he's a non-resident and a non-citizen of India. I have an entertainer, somebody who is an entertainer who can perform in India, who is related to the acting department, the arts, music, singer, musicians, entertainers. But again, they are a non-resident and non-citizens, or a non-resident sports association. Now, the nature of income. If the sportsman, if the athlete, a cricketer, a person playing any other sports, not just cricket, but any other sport, if this non-resident, non-citizen earns this income in India by participating in a game or sport, of course, 115BB will not be covered in BBA. If you are participating in games, etc., which are covered by 115BB, so 30% tax you have to pay. Other than 115BB situation, just give me a second. Other than 115BB situation, if there is any income arising from any game or sports, that income is covered here. Participating in some advertisement and you earn some income, contributing to some newspaper articles, these incomes will be taxed at the rate of 20%. No expenses allowed. A non-resident sports association earns income. So a non-resident foreign team comes to India, plays some sports in India, and that non-resident team is of a foreign country. So that country's sports association, cricket association, or any other association, Olympic association of that country, any association, a sports association, is going to get a guaranteed payment from India because their players are participating. So what the players earn will be taxed at 20%, And what this sports association gets as income, that is also going to be taxed at the rate of 20%. Similarly, if that entertainer performs in India, then from the performance, whatever income is derived will be taxed at 20%. 115 BBC. Okay. Anonymous donations. Very frequently comes up in your question paper because 115 BBC is, sorry, 115 BBC is a section which applies to a charitable trust, and charitable trust is something that regularly is part of your paper. Anonymous donation means we are talking about all those donations where the identity of the person donating, the donor, is unknown. Meaning the trust does not keep a record of who the person is, what is his address, what is his permanent account number. It is a secret donation that is given. The donor does not want to be identified. Now, in the garb of anonymous donation, black money can be converted into white money very, very easily. And so there is no exemption provided. You will have to pay tax at the rate of 30%. So number one, this anonymous donation will be included in the total income. But then a slightly detailed formula, slightly complicated formula has been prescribed. They are saying that this anonymous donation will be divided into two parts: the taxable part and the exempt part. What do you mean by this? Exempt from the 30% rate. I am not saying it is exempt from income tax. Nana. It is exempt from 30% rate, which means this anonymous donation is surely going to be taxable. I will not pay tax according to 30%. I will pay tax according to slab rates. And this taxable component, I will pay tax at 30%. So eventually tax is being paid on the entire amount of anonymous donation. The only difference is that a certain amount is not taxed at 30%, that is taxed at regular slab rates applicable to a trust. So what is that exemption? 5% of the total donations received, or a standard amount of 1 lakh, whichever is higher of the two. Now the only thing worth mentioning here would be, it says 5% of total donations. 5% of total donations. What do you mean by total donations? Total donations will include anonymous donations also. Total donations will also include known donations where the records of the donor are maintained. Total donations will include corpus donations as well. Total donations will include normal, regular, revenue type, non-corpus donation. Everything will be included in total donation. 5% of this total, or a minimum amount of 1 lakh, whichever is higher, will be exempted. This amount which is exempt is reduced here. Balance amount is taxable and taxable at 30%. And whatever is the amount of exempt anonymous donation, they shall definitely be chargeable to tax, but they are only exempted from the 30% rate. They are taxable as per slab rate. This whole concept of 115 BBC dividing the anonymous donation into two parts, taxable 30%, exempt component pay tax as per slab rate. This whole concept is only applicable if you are a charitable trust. So if you are a religious trust, then you don't need to bother about this 115 BBC. If you are a religious trust, 115 BBC is not applicable. Meaning the 30% tax rate is not applicable. you will end up paying tax at the rate of slab rate only. Normal tax rates will apply. Anonymous donations, but they will be taxed normally if it's a religious trust. If it is a charitable trust, only then this will have to be done, which also means anonymous donation for a religious trust, like anonymous donations will be treated like normal donations only. For a religious trust, anonymous donations are treated as normal donation. Known or unknown, everything is normal for religious trust. It is only for charitable trust that this division, this breakup has to be done. 115 BBD. Now this section applies if the assessee is an Indian company. For this section to apply, these are 4 conditions prescribed. The person paying the dividend is a foreign company. The person receiving the dividend is obviously the shareholder, but every shareholder is not covered. It's an Indian company. The dividend is as defined in 222A to 222D. Section 2, clause number 22, subclause number A to subclause number D are covered. The minimum voting power required is 26%. Now, if all these conditions are satisfied, then it's an Indian company. The regular tax rate for an Indian company is 25%. Generally speaking, but this dividend is going to be brought to tax at 15% tax rate. So the rate of tax for this dividend income will be 15% and not the normal rate of 25%. 115 BBD is specifically applicable in this situation only. That means that just give me a second. Say for example, the payer of dividend is a domestic company or a mutual fund or a cooperative society. You are not getting dividend from a foreign company, you are getting dividend from these organizations. Then very clear कि भाई section 115 BBD is not going to apply. Similarly, if the receiver of dividend is, for example, an individual, for example, HUF, partnership firm, association of person, body of individual, not an Indian company, then also 115 BBD will not apply. If the nature of dividend is defined in 222 subclause number E, a private limited company giving a loan to a shareholder and the voting power of the shareholder is minimum 10%, then also the section, then also 115 BBD will not apply. Dividend will be taxable under 222E. And the fourth and the last situation to imagine will be voting power is below 26%. Then 115 BBD is not applicable. See, why is this necessary to draw this distinction that 115 BBD applies or 115 BBD does not apply? If all these conditions are satisfied, dividend income shall be taxed at 15% gross. No deduction shall be allowed. No deduction of any expenditure shall be allowed. That means if 115 BPD applies, then no expenses allowed as deduction. The gross amount of dividend will be chargeable to tax at a concessional rate of 15% for Indian company. But which also means that in these situations that we are talking about, my tax rate will be the regular tax rate. If I am an individual, then regular rate of slab rates will apply. If I'm a partnership firm, so 30% will apply. And that implies that expenses will also be allowed as a deduction. Now, as per the last year amendment, I'm sure you might be aware of this, that when you compute dividend income, the only expense that is allowed as a deduction is interest on loan, and that too maximum deduction of 20% of that dividend income. But yes, this deduction is going to be available if 115 BPD does not apply. If 115 BPD applies, then dividend income will be taxed at a gross rate of 15%. 115 BBE, a section specifically created to target black money. If your incomes are taxable under section 68 to 69D, what are these? We are talking about cash credit. We are talking about undisclosed money. We are talking about undisclosed investments. We are talking about investments not fully disclosed but only disclosed partly. We are talking about unexplained expenditure. In fact, all these, we are talking about transactions done, hundi transactions, repayment of hundi, borrowing money. All these incomes, all these sections have been created to specifically target the black money, the undisclosed income, and when they will be charged to tax, when they will be brought to tax, it is a very high, very harsh rate of 60%. Every budget says there is a mandatory surcharge of 25%. We don't care what the amount of income is, irrespective of the amount of income. If your undisclosed income is only 2 lakh rupees, yet you will have to pay this amount of surcharge, a mandatory surcharge of 25%, and a health education cess of 4% shall apply. That means effectively, if 100 rupees is my income, 60% ka tax, 25% of that 60%, surcharge will be 15. I'll take a total 75, and health and education cess 4%, 4% of sorry, some wrong. So there is a mandatory surcharge of 25%. This will take it to 75. 4% health education cess of this 75 will be effectively 3. So 78% of your income is actually being paid in the form of tax. This is just the tax. Interest and penalty will surely be applicable and will be separately applicable, but this is just the tax that you have to. So if you try to have undisclosed income, investment made in black, fake expenses are debited and debited in your books, you purchase some jewelry or shares but don't show the full value, you pass fake entries in the books to convert your black into white, these sections will get attracted and there will be 60% tax as per 115 BBE, effectively working up to 78%. You will not be entitled to any expenses. No deduction will be allowed of expenses. No deduction under Chapter 6A. No set off of any loss will be permitted. The last section that we'll take up for today's discussion, and tomorrow we will continue with the second part of this topic, where I will be discussing the concessional tax rates. The rates of tax, concessional. The last thing that we'll do today, 115 BBF. This is a section that is specifically introduced to encourage resident persons to do research and development in India, and when they patent their invention, they will be able to earn royalty income. We will impose tax at the rate of 10%. At least 75% of the expense should be, of the development expense should be incurred in India. Only then this section will apply. When you say patent is to be developed in India, the whole intention is that yes, patent should be developed in India. The expense incurred should be 75, 80, 85%. Then the royalty income that you generate out of this will be taxed at the rate of 10%. No expenses allowed as deduction. So on gross basis, you will have to pay this tax. If you are a domestic company, then you are liable to the provisions of minimum alternate tax. But on this income, minimum alternate tax will not apply. That means as far as this income is concerned, it will be fully excluded from the book profit working. Related expenses will also be disallowed and incomes will also be reduced, and there will be no MAT payable on this income if you are a domestic company who is earning this royalty. So for today, this is it. Second part of the video, second part of the lecture that I want to discuss is 4 specific sections that have been introduced over the last 2 years. 2 sections for domestic company, 115 BAA and BAB, 1 section for an individual BAC, and 1 section for cooperative societies, that is BAD. New tax regime, concessional tax regime. Too many details to study. So that will require a separate lecture for discussion. I'll revise it only. I will go through it on a quick fire basis, but it will be a sort of revision which cannot be just finished off in 5-10 minutes. You will need a full session of 1 hour. And so we will be discussing this tomorrow afternoon at around 11:30 or 12 o'clock. I'll schedule up a session on YouTube on the Unacademy channel only. You'll be able to watch the lecture live. So we'll continue this thing tomorrow. Hope your revision was quite quick here. It was quite helpful. This lecture, tax rates, something necessary to study for your exams. Hello. Goodbye. Have a nice Sunday. See you tomorrow. Bye.